Hi, this is John Prasinos, Editorial Director of Investing Daily. Welcome to my video presentation for Friday, October 15. To view our full range of publications, visit our website at investingdaily.com. Also visit the website of our subsidiary, streetauthority.com. Well, anxieties are rising on Wall Street amid supply chain bottlenecks and their resulting inflation. However, when examined dispassionately, the latest employment, economic, and earnings data paint an optimistic scenario, albeit with the usual caveats and nuances. Let's examine these tailwinds. First, take a look at the following chart. The Labor Department reported Thursday that jobless claims totaled 293,000 for the week ended October 9, below the consensus estimate for 318,000. That was the first time initial claims fell below 300,000 since the nadir of the pandemic in early 2020. Continuing claims fell by 134,000 to 2.59 million. The jobs market is healing. Corporate earnings are a bright spot as well. Take a look at the next chart. For Q3 2021, the estimated earnings growth rate for the S&P 500 is 27.5%. If that is the actual growth rate for the quarter, it will mark the third highest year-over-year earnings growth rate reported by the index since 2010. This week, the financial services sector kicked off Q3 earnings season with major banks exceeding expectations. This outperformance by the financial services sector bodes well for the economy in Q4 and into 2022 because banks are economic bellwethers. This week's earnings results so far show that the banks are writing more consumer loans as the economy reopens. In terms of positive Q3 guidance, the technology sector is in the vanguard. Rising bond yields lately have impeded the tech equity rally because higher rates diminish the value of future earnings. But I don't see this dynamic as a long-term threat to tech shares and, by extension, the overall stock market. Tech firms have thrived during the pandemic, and their prosperity should continue in the post-COVID world. But rapid economic recovery has put strains on the supply chain. Scrutinizing Q3 earnings calls transcripts to date, research firm FactSet searched for certain terms related to factors that can affect operating results. FactSet then drilled down to determine whether the company cited a negative impact, expressed a negative impact in relation to the factor for either the quarter just reported or in guidance for future quarters. The results are shown in the following chart. Take a look. Supply chain disruptions and costs have been cited by the highest number of companies in the S&P 500 index to date as a factor that either had a negative impact on earnings or revenues in Q3 or is expected to have a negative impact on earnings or revenues in future quarters. Among the 21 companies studied, 15, or 71%, have discussed a negative impact from this factor. After supply chain disruptions, labor shortages and costs, COVID costs and impacts, and transportation and freight costs have been discussed by the highest number of S&P 500 companies. Meanwhile, take a look at this chart. According to the International Monetary Fund, the global economy is projected to grow at a year-over-year pace of 6% in 2021 and 4.9% in 2022. Inflation is rising, but it's expected to retreat to its pre-pandemic levels in most countries in 2022 once supply chain disruptions are ironed out. Right now, the growth story lives on, and we've just pinpointed an investment play that's about to blast off. For details, follow this link. If you're looking for outsized growth opportunities, this URL will steer you in the right direction. Well, that's it for now. I'm John Prasinos. Thanks for watching. Stay invested and stay safe.